Thank you very much. Delighted to be here. Thanks very much. I'm going to move out of here so you can see him on my wheelie chair. So we're talking about hedge funds and innovation. Jason, why don't you tell me a little bit about the kind of bigger picture in terms of what you've seen as you've been traveling around the world?
Sure. And just as background, my name's Jason Mitchell. I run several long-only funds as well as a long-short fund for GLG Partners. We're the first or second largest hedge fund in the world with about 60 billion of assets. From a picture of liquidity, I would say, just as background, it's an interesting sort of unique time in the sense that from a macro picture, there's almost unprecedented coordination and activism among central banks, some more active than others, particularly Japan and the US relative to Europe. It's driven in probably the last 3 to 6 months a repricing of the cost of capital and a number of tremendous reverberations across the sort of asset classes and capital structure. What that means is, over the last couple of years, there's been a big hunt for yield. A number of investors have sort of tried to find assets like real estate, sort of duration assets, long life assets that throw off sort of a predictable annuity stream. And suddenly, with a lot of this central bank activism to try and reaccelerate, economic growth, we see this repricing of the cost of capital is driving investors into more growth-related assets with lower yields. What that means is you're finding more interest in equities outside of bonds, outside of real estate, funds like myself, investments into small and medium enterprises. Japan, for instance, is sort of, in my mind, one of the most interesting examples of this activism going on. As some of you may well know, with the new government under Shinzo Abe in November of last year, you have a central bank that has actively tried to actively increased its balance sheet, and what it's done is try to reverse 20 years worth of deflation into inflation, driving up prices, ultimately trying to induce increases in wages and resuscitate the economy. Well, there are a lot of naysayers that certainly can paint a number of structural arguments over the next 5, 10, 20 years from a demographic perspective, from a lack of energy resources perspective, from a security perspective. But I think what people miss is that it has worked in the short term. So the rate of change has absolutely been tremendous. Inflation is now up. Business confidence is suddenly up. It feels like we're on the cusp of a lot of reinvestment by local businesses. The exporters are starting to reinvest more in plant and equipment in industries like the auto industry. So I would say it has worked. The interesting thing will be over the next 12 to 24 months as we sort of finish this period of monetary easing and the real work starts, which means central banks can only print so much money, but within the self-help program, ultimately real structural reforms need to take over. Deregulation, sort of efficiencies introduced around labor regulations, labor laws. But personally, I think it will. I think it is proving successful, and it will prove successful.
So that's a message of hope we haven't
Sure.
heard for a while. John, give me just a little introduction
Sure.
for everybody, and then
Sure, this is worth
tell
it.
me from your perspective. I think they work, but they don't magnify your
So it's
voice,
all about
right? Just for the camera.
as opposed to the audience. Okay.
It's to make you look good.
Got it. That takes some doing. My name's John Pitts. I'm at Forbes Private Capital Group, which is a subsidiary of G2 Investment Group. Forbes Private Capital is the capital formation fundraising element. We raise capital both for internal strategies in merchant banking and asset management, as well as non-competing external mandates across the range of alternatives, private equity, hedge funds, real estate, with a particular focus in niche private equity and opportunistic credit strategies. It's been a challenging fundraising environment. The gentlemen were up here talking about venture capital earlier. I think there has been genuine interest on the part of investors in non-traditional asset classes. Well, certainly, hedge funds and private equity, fit that category, and really it's been driven. I mean, Jason mentioned the recent rise in rates, but if you look over the longer term, we're really at 40-year lows in terms of yield. So for traditional investors like pension funds and insurance companies that historically have had a conservative asset allocation mix and a large exposure to traditional fixed income, bonds, gilts, boons, treasuries, so forth. All of a sudden, they're not generating anywhere near a sufficient yield against fixed liabilities, so they need to look for creative, uncorrelated sources of income and yield, and those come in the form of either in private equity or in credit. Things like direct lending, things like royalties, things which are generating yield, which are largely uncorrelated to the overall market.
Mm-hmm. And so, does this mean you're seeing a lot more business? Difficult to get business? How does it feel?
I think it's been challenging for smaller, less established fund managers. I think that there's been a substantial risk aversion, particularly in Europe over the last 2 years, given the substantial economic uncertainty that's led investors, even ones that should have a long-term view. Private equity is obviously a longer-term asset class and should sort of look beyond short-term economic turbulence. But a lack of certainty in terms of the macroeconomic environment makes people hesitant, and people naturally gravitate towards the most liquid asset classes. Venture capital is probably an interesting example. It's I think, a more cyclical asset class than many people realize, and it's been largely out of favor, I think probably because there's been too much capital into the asset class over the last few years, which has dampened returns. So I think in the last few years, you've had the less successful managers have had a difficult time raising new money. The better managers have had some success, and that will create fewer sources of capital chasing after good quality ideas, and inevitably that will probably inflate returns and bring capital back to the space in a few years' time and start the cycle again.
Jason, where are you advising your clients if they put their money in? Is it in terms of geographical area?
I would say that sort of in my fund, obviously, and then sort of I'm allocating, the fund. But right now the big question mark is emerging markets. I mean, the emerging markets is sort of enjoyed a big tailwind of money flows over the last number of years, and it looks like that's reversing now as the U.S. the Fed is basically beginning its tapering program, which means that strong dollar rates go up, and you'll see a reversal of that. It's still up for debate. China is actively trying to sort of manage a deceleration in GDP, but that's the big area that is of question right now. But in terms of themes that I'm investing in right now, I mean, agriculture is one that I think is unique in the sense that this year is going to represent one of the biggest harvests that we've had from a grain perspective of the last 20, 25 years in terms of the U.S. So, these headlines that we've seen over the last 3, 4, 5 years of the carrying capacity of the world and not enough food, certainly it's maldistributed, but we're going from a period where the stocks to use level was 4% for this year is now it's going to sort of readjust to 15% going into next year. That's sort of the normal level, and assuming a more normalized weather season and we're past the El Nino and La Nina sort of period, that could probably move higher. So, our sense is that going forward for the next couple of years, we're going to, be in a period of food deflation. You're going to see corn, for instance, peaked at $8 a bushel. Right now it's at $4.50. It's going to go a lot lower. Sugar is at a sort of a 7-8 year low. Coffee. I mean, if anyone's bought a Starbucks, a Grande Americano, you probably paid $2.10. As I did last year, you paid $2.10. Coffee beans are down 30-40% year on year. And what's interesting about that, this cyclicality and volatility in commodity prices is it's differentiating companies that are willing to take those savings and reinvest into not shareholders but stakeholders. So, for instance, Starbucks has done a pretty good job, I'd say, of reinvesting into loyalty cards, into really building brand. I go to Starbucks a lot. I end up, getting a free coffee every 5 or 6 coffees. Those kinds of reinvestment programs versus other businesses that are just trying to sort of, take that margin away. Financial technology. When I'm done with this conference, I've got a conference call with a company which is sort of, an old school fintech company, but NCR, which amazes me because, it's sort of old economy, but what they're doing in terms of automated, kind of checkouts, in the retail industry blows me away. But, you're obviously seeing a lot of new IPOs, in this area. There's a lot of innovation. I think it's been driven by a lot of, frankly, a lot of the Facebook-led sort of liquidity and interest in this space. So those are 2 areas.
John, what about you? What are the sort of themes that occupy you?
I think certainly the investors that we speak to are concerned about inflation protection, and Jason mentioned growth. I mean, I think in Europe, the most optimistic view is that we're going to have very modest growth at best over the next few years. So people have to, both figure out how can they make money in an environment with very little top line growth, but still have an eye towards, what everybody feels like is impending inflation with all of the money that's been created by the central banks. We now had $10 trillion sort of chucked into the bonfire. So there's a perception amongst long-term investors that I don't know if it's next month or next quarter or next year, but certainly inflation's coming. So that leads to a desire to have inflation-protected assets like real estate, long-term sort of cash flows. And in terms of other asset classes like private equity, I mean, I guess the point is in Europe, even in a low growth environment, there's very talented managers who are capable of buying companies and transforming businesses. And with no disrespect to anyone, every private equity platform says that they add operational leverage, but it's not clear that they all do or have the track record to prove that. So I guess the point is people are very selective about which managers that they choose in terms of investing capital with. And for people who are going out and buying businesses inexpensively rather than just sort of applying financial leverage and hoping for growth, there's a real distinction and differentiation between people that are successful at actually transforming businesses and businesses that themselves provide cash flows and inflation protection.